Today we're going to talk about civil fraud penalty risk. How does the IRS go about using badges of fraud to build a case? And why is the civil fraud penalty so damn serious? Well, first of all, the civil fraud penalty is the IRS most serious civil allegation because it's not about mistakes. It's about intentional tax evasion. Under Internal Revenue Code Section 6663, the penalty is 75% of any underpayment attributable to fraud. And here is what most taxpayers and most representatives don't realize. If the IRS has enough evidence to assert a civil fraud penalty, they already have the evidence necessary to pursue a criminal tax case, prosecution, incarceration. So, how does the IRS build a tax fraud case? Well, the IRS does not need your confession. They build tax fraud cases by proving patterns of behavior that are known to run with fraud. They investigate and document what the IRS calls badges of fraud. These are early warning signs that suggest intentional tax fraud type conduct. From there, the IRS develops what it calls firm indications of fraud. That means they look for evidence of deliberate actions taken to mislead or deceive. At that point, your case can escalate into a civil fraud penalty, or much worse, a criminal tax referral, or both. So, tax fraud cases are all about patterns of behavior, not one single mistake. But a single sketchy issue, while not alone will prove tax fraud, but it'll start them looking for badges of fraud and additional patterns. The IRS evaluates tax fraud based on the totality of the circumstances. That means they look for clusters of fraudulent behavior across different categories. When multiple indicators appear together, the IRS begins to infer criminal tax content into your behavior. And once your criminal intent is inferred, the entire posture of your case changes exponentially against you. So what are the common badges of fraud the IRS looks for? The first category is fraudulent understatement of taxable income. Examples of this type of behavior include reported income is consistently and substantially less than the total deposits into all bank accounts, or cash-based receipts do not get reported for income tax purposes and they can prove it, or personal spending consistently exceeds reported earnings, or overstated expenses and personal expenses are claimed as business expenses, or fraudulently claimed credit. The second category is books and record problems. Cooked books that intentionally and fraudulently understate taxable income, missing records, incomplete records, or records that don't reconcile with third-party data. The third category is concealment or obstruction, using third-party nominee accounts to hide taxable income, hiding business and personal assets, especially in a collection scenario, or providing misleading and fraudulent explanations. And finally, inconsistent or implausible statements, stories that change over time, or verbal or written explanations that conflict with objective evidence. So there's some structural risk here that most taxpayers miss. Once the IRS proves that any portion of an underpayment is due to fraud, the criminal tax exposure exponentially expands against the taxpayer. The IRS can treat the entire underpayment as fraudulent, unless the taxpayer can prove otherwise. That means that generalized explanations are not enough here. You need transaction-level proof to separate error from criminal tax intent. Moreover, there's no de minimis rule for income tax evasion, but sentencing turns on the size of the tax loss. For example, $30,000 of tax loss is 1 year in jail under the federal sentencing guidelines. More tax loss, more jail time. So why does tax fraud risk change everything in your case? Well, fraud allegations dramatically ramp up the IRS's leverage. First, it triggers a 75% fraud penalty on any fraud-related portion of your understatement. Second, it removes entirely the statute of limitations if the IRS comes in and alleges fraud. They can literally assess tax all the way back to the dawn of time if they want to. And third, it creates a direct pathway to criminal tax prosecution, which is the most serious by far. At that point, your case is no longer just about civil exposure. So what are the most dangerous mistakes we see taxpayers and more often their representative making? Well, the biggest mistake is trying to fix the issue after the IRS starts asking questions with the wrong representative. Whatever you do, don't let the very tax professional you hired to represent you become government witness number one against you. CPAs, EAs, and other tax preparers do not have attorney-client or work product privileges, and therefore they can be forced to testify against you whether they want to or not. There are no secrets with those folks. Hiring the original tax preparer to represent you is an exponentially worse idea, as they're likely to throw you under the bus to prevent the loss of their licensing and the possibility they go to jail with you. Why? Aiding and abetting income tax evasion. So what are other fatal mistakes that taxpayers make in potentially criminal tax audit investigations? They include creating documents that did not originally exist, backdating records, or adjusting numbers to match some sort of defensive narrative someone came up with. These actions are exactly what the IRS looks for to establish criminal tax intent, and they can turn a weak civil case into an extremely strong tax fraud case. So how do we go about defending against civil and criminal tax fraud risks? Well, criminal tax defense starts with control, all right? Control over documents, control over chronology, and control over communications, most importantly. As dual licensed tax attorneys and CPAs, we excel at building an evidence file based on objective records, not on untested explanations or assumptions. And when the facts are sensitive, we have taxpayers route all defense decisions as strategies through counsel, because client statements can become the most damaging evidence against you. So in closing, why strategy matters early on in your matter. If your audit or criminal tax investigation involves income tax discrepancies, missing records, or inconsistencies in reporting, you should assume the criminal tax risk level is elevated. At the tax law offices of David W. Klasing, our dual licensed tax attorneys and CPAs routinely handle these matters as both civil and criminal tax exposure problems. We build defensible records, we control communication strategy, and we work to keep your matter civil at all costs. Call 1-800-681-1295 or visit Klasing-associates.com to schedule a confidential reduced rate initial consultation today. You will not regret it.